Hi everyone, Justin Walsh here, branch manager with Franklin Direct. And this video is in regards to flexible down payment options for first time or even repeat home buyers, because there is a lot of misconception or lack of understanding on how much money do I need to put down to purchase a property. And there's some very flexible options for buyers that don't have a lot of down payment funds. And we want to give an overview of what that looks like, as well as what questions you should be asking and the important details of that loan, and just knowing the differences between those products. So the following screen is a rent versus own home buyer report. And these are immensely helpful for buyers just during the home buyer education process to know what are my available options, what does it look like comparing renting versus owning, am I going to save money on my income taxes, what are all the loan options, all of that we keep in these reports. And this is going to be an overview of the available options for lower down payments. So conventional loans allow for a down payment for as little as 3%. So you can see here in this example, this is a $750,000 home with a down payment of 3%. FHA over here requires 3.5%. And then there are some unique affordable products out there that are becoming more and more common, which also require 3%, but have a little bit lower rate and don't require things like PMI or other costs on some of these affordable products. There's a lot of properties eligible for these affordable products, but that's the overview. 3%, 3.5%, and 3% is pretty much what you're going to see. There are down payment assistance programs, but we are very cautious in recommending those because on down payment assistance, you are borrowing money for your down payment, and that's another lien or another loan that's owed on title, and it also impacts your rate. So when you use down payment assistance, your rate on your first mortgage is a lot higher than if you had just put that 3% down yourself. So it's our professional recommendation, always do your best to try and save for 3%, or you can use gift funds from family for 3%. But putting down a down payment of your own versus down payment assistance is always a better idea. Jumping a little bit further into this report, this was a homeowner or a potential homeowner that rents for $3,000 per month. And as you can see on these options, they had payments ranging from $5,300 to $5,800 per month. And one of the things that's very important to understand as a potential home buyer, when you purchase that house, you are going to not only be saving money on your income taxes, which you can see in these columns here. These would be the monthly income tax savings in year one for this particular scenario. Always talk to a financial advisor or CPA, but there are significant tax savings buying a house that you just don't receive as a renter. And then also you're paying yourself each month. So out of your mortgage payment, you're going to have a certain amount of money going towards your equity that just doesn't occur as a renter. So when you factor in the tax savings and you factor in the amount that you're paying yourself each month, those things are not occurring as a renter, and it does help offset these mortgage payments quite a bit more once you factor in the income tax savings and then the fact that you're paying yourself. Another thing in these buyer reports that's very helpful to see is, okay, what would my net worth be after 10 years of homeownership? Well, we know as a renter, your rent's going to keep going up. Rent is not a fixed payment. Landlords can increase the rental amount, inflation, other things. We've seen rents go up rather rapidly over the last 5 years, and that can continue happening. On average, rents increase about 3% for every year. Well, in buying this property, this would be the total of your monthly payments. This doesn't factor in any refinances that can occur during the next couple of years as rates come down. This is how much money you would have paid into your own equity without refinancing. This is the total tax savings during those 10 years. And then most importantly, and this is what all homeowners experience, is this is what the property value would be in 10 years with just a 4% property appreciation rate annually. In California, we've been closer to 6% over the last 50 years. So 4% even, and you have $101.1 million property at the end of 10 years, only owing $618,000 and establishing $491,000 in net worth or equity. And this was off of only a 3% down payment. And this is what homeownership allows folks to do. And we've seen clients time and time and again that purchased just a few years back now have equity. Whereas obviously as a renter, there's just no equity being established. And this is a very important visual because yes, when you buy a house, there is going to be a little bit of a payment jump. You are going to go from, in this case, $3,000 in rent to $5,800 in a mortgage payment. But once you factor in the tax savings, you factor in what you're paying yourself each month, and you also factor in that this rent will keep going up, this payment will only go down through lower rates. And then fast forward to 10 years into homeownership, and there's equity established, and you made a great investment into your future. So as always, please feel free to contact us if you have any questions. There's a lot of creative ways to look at these things, and these types of reports for your specific scenario is really the first step in getting clarity on whether or not it's the right time to buy. We'll talk to you soon. Thanks. Bye.